the markets go down, the markets go up, the media has to craft a narrative. They can't just say, hey, on Bloomberg today, we're just going to talk about how the market is. They have to come up with a narrative because they're ultimately there to sell advertisements, keep people watching the channel. So, nobody's just going to say, yes, sentiment was too high. But in a lot of cases, I think these things can clue us into what maybe takes a news story and makes it a little bit worse amplifies it from a market perspective.
Yeah. So Daniel, we talked about there were some reasons the market sold off. The market has since bounced back. Where are we at today?
Yeah, well, depending on what you're viewing as the market in the US, you could say that we've actually recovered all of the lost ground back to all-time highs. So the Dow back to all-time highs, not necessarily right this second, but you get the gist. Same with the S&P 500 equal weighted index, which we would generally view as a better representation of the broader market. The S&P 500 cap weighted almost got back to, its previous high pre-August 1st. So,
but that cap weighted index is predicated on the performance of 7 really, really large companies. Yeah. So the equal weight, I think, is a better representation because it equally represents all 500-ish companies in the index.
Yeah, that's well said. And so when you see a recovery like that, well, I guess the first thing that comes to mind to me in terms of a question is well, why did that happen? What drove that? So, I mentioned that a lot of the time you can get knee-jerk type reactions. I think that was part of it. But the other part of it certainly is related to the Federal Reserve and stepping in and essentially more or less committing to reducing the level of the baseline interest rate here in the United States, which, as I said at the very beginning, is and has been the focal point of investors and the market in general. So, we came into this year with broad expectations for some serious rate cuts. I think coming into this year, we had expectations for 6 rate cuts. Almost immediately, that started to get walked back, at least by investor perception and expectation, all the way down to the point where at the end of April, you only had 1 rate cut that was expected to be enacted throughout the course of 2024. And that was because you had just a continuing level of economic strength. So when you have an economy that's running hot and essentially growing as it should be, you don't necessarily need to stimulate that economy further, which is what cutting interest rates aims to do. Now, if you fast forward from April to today, we talked about how we've seen some deteriorating economic data. That jobs report was certainly an example of that. And you've had the Fed that's come out and without saying it, essentially committing to stimulating the economy in an attempt to make sure we don't go into this free fall economic type downturn and just kind of stimulate things and make sure this is just a slowdown, not an actual kind of catastrophe. And the market has paid attention to that, for sure. And I guess I just want to talk a little bit about, or just open the dialogue on different asset classes.
Real quick, before you jump into the asset classes, so with regards to Powell's comments, or his soft commitment on cutting policy, cutting rates, was he open at the beginning of the year? Do you remember what some of his rhetoric was at the beginning of the year? Even though the futures market was pricing in 6 rate cuts on January 1st, what was Jerome Powell saying back then? And is it different then than it is today? Any comments there?
Yeah.
I don't quite recall what
if you want to find, if you watch Powell's press conferences, or to be honest, anyone in his role's press conferences or Q&A sessions, they're about as non-committal as you can get. And that's by design. They have really ratcheted down on making sure that people like Jerome Powell are going to be less market moving, because you can imagine if he came out in January and said, we're not going to cut rates until October, like that would have cratered the market, right? Like, right or wrong, it doesn't matter. Like, it would have caused some serious issues.
Yeah, because it was so vastly different than what the bond market had priced in.
Exactly. And so what you can perceive, and it's actually hilarious when I take a step back and think that most people don't view this as a normal thing, that when Jerome Powell goes and gives his prepared remarks, which have to be prepared because, in an attempt to not stoke volatility, he literally has to have scripted remarks.
Well, I think there's like 12 words that are different.
Yeah, and so
different releases.
That's what I'm getting at.
Yeah.
Like you can pull up the PDF of the previous press release with the commentary, and then you pull up the current month's, and usually someone on the sell side will highlight the 12 or 13 or 15 words that are different. And it's not like it's a major difference. It's something to the tune of, we will continue to watch the data closely, and we have watched the data closely and have observed. Like, it's just that minutia of a difference.
He said substantial instead of broadening.
Right.
Just little tweaks.
So people watch that type of stuff. But he had no committal remarks at the beginning of the year. This was just investors and market participants extrapolating what they think was going to happen based on the underlying fundamentals of the economy.
Got it. Okay.
Now, today, we do have a little bit more concrete verbiage coming from the Federal Reserve, which ultimately, that to me, gives some of what's happened in the market a little bit more legs. Different types of assets perform differently in different interest rate regimes. So you can take probably the easiest example would be your bond proxy income-oriented equity sectors, as we've talked about before on this podcast, that generally should perform well in a falling interest rate environment and should perform.
Maybe you could remind us what sectors those are.
Yeah. So sectors like utilities, real estate, to a lesser degree, consumer staples, and then, the telecom portion of communication services. Those are the sectors that you generally will see do well in a falling rate environment and not so well in a rising rate environment, because they are, like I said, bond proxies if investors are using them for income. If interest rates are rising and you can get essentially income from the bond market, that is going to impede on the attractiveness of those bond proxy sectors. The exact opposite is true when you have falling rates. So falling rates, you might have investors look towards those sectors in an effort to kind of supplement some of the income being produced by the portfolio.
So if I can't get a high enough interest rate in my money market as rates come down, instead maybe I invest in a utility stock, because the utility stock is perceived to be relatively safe and a higher yielding type equity that can get me the income that I might need.